I'm Debbie Matz, Chairman of the Board of the National Credit Union Administration. Welcome to the third segment in NCUA's series on the evolution and the eventual resolution of the crisis in the corporate credit union system. Now that Part 1 has explained the corporate's history and operations, and Part 2 has described how the corporate crisis developed, Part 3 will outline where the corporates stand today. In addition, this segment will outline key ideas of how the situation will be resolved with the least possible cost, while ensuring that consumer credit unions continue to have access to services you need from corporate credit unions. At NCUA, we are committed to pursuing an open, transparent process that empowers the credit union community with the ability to decide for the long term how you will obtain the services your members need. At the same time, we are committed to continuing to regulate the nation's federal credit union system rigorously, ensuring safety and soundness. Thank you for taking the time to consider these issues. We look forward to keeping up a candid dialogue with you as we move beyond this crisis toward a successful resolution.
Welcome to the third installment in our series of presentations on the crisis in the corporate credit union system. In the first installment, we provided some historical background on corporate credit unions and their relationship to consumer credit unions. We also discussed the critical services that corporates provide. In the second installment, we talked about the economic situation that led to the current crisis. We discussed the corporate's investments in private label, mortgage-backed securities, how the economic downturn affected the securities, and the impact on corporates and their ability to continue to provide services to consumer credit unions. In this third installment, we will focus on NCUA's efforts to stabilize the credit union system, to ensure access to adequate liquidity so that lending activity and payment systems processing will continue uninterrupted, and to reach the least costly outcome for federally insured credit unions. In a previous installment in the series, we discussed the immediate impact of the economic downturn on many of the corporates. The result was that the corporate's historic role of liquidity providers to consumer credit unions was significantly impaired. In addition, the losses on their investments in private label, mortgage-backed securities threaten the future viability of a number of corporates. As the severity of these problems emerged, NCUA's primary focus was to ensure that the critical services corporates provide to consumer credit unions could continue without disruption. The services that consumer credit unions receive from corporates are critical to their ability to provide financial products and services to the credit union system's 90 million members. The investment losses at two of the largest corporates became so significant that they threatened the corporate's continued financial survival. Because of the potential impact on consumer credit unions, NCUA had to step in and take action to ensure that corporates continue to operate. NCUA's actions included an injection of capital and the conservatorship of the two largest corporates. We will discuss these actions in further detail later in this presentation. The losses at the corporates and the cost of the stabilization efforts are ultimately borne by federally insured credit unions. As we go through this installment in the series, we will discuss in detail the reasons why the burden of corporate losses is being borne by consumer credit unions. However, it is important to note that, from the beginning, NCUA has made every effort to minimize the final cost of the problems. We will review the actions taken by NCUA to minimize these costs to credit unions. Finally, it is crucial that the nation's credit union system never again be threatened by a single group of institutions. That's why NCUA is revising the corporate regulations to create a stronger regulatory framework. Later in this presentation, we will go through the changes that NCUA is considering to the corporate rule. With a stronger regulatory framework, consumer credit unions will then be better able to determine if they want to continue their relationship with their corporate or obtain services elsewhere. During the previous installments of this series, we emphasized the role of corporates as liquidity providers to consumer credit unions. The credit union system must maintain access to an adequate level of funds in order to meet consumer funding needs, payment transactions, loans, etc. Failure to meet those funding needs would be devastating not only to credit unions, but to confidence in the overall economy. Specifically, we discussed in detail how the crisis in the real estate market affected the economy and the availability of liquidity. Corporates had historically relied on their ability to sell or borrow against their mortgage-backed securities as a means of maintaining adequate liquidity. This practice became unworkable as the value of the mortgage-backed securities plummeted. We also discussed how corporates, in their role as liquidity providers, needed to be able to grow and shrink based on the liquidity needs of consumer credit unions. We noted that, in one 5-month period, shares in corporates grew about 90%. There have been other occasions when shares have declined by as much as 30 to 40% over an equivalent time period. Historically, growth and contraction has not been a problem for corporates. As we discussed in detail in the earlier installments, Traditionally, the corporate's investments were highly liquid and could readily be converted to cash to fund share withdrawals. We also discussed how the economic downturn and problems in the real estate sector had a severe impact on corporate liquidity. In 2007 and early 2008, the level of consumer credit union share deposits in corporates remained relatively stable. During that time frame, the first signs of the economic downturn were developing and credit unions were seeking a safe harbor for their funds. Consumer credit unions saw corporates as the safest place to put their money. In February 2008, consumer credit union deposits in corporates were just under $91 billion. In late 2007 and early 2008, the unrealized losses on securities held by corporates increased significantly. As consumer credit unions became aware of the growing trend in unrealized losses, many began to withdraw funds from the corporates. By December 2008, consumer credit union deposits in corporates were $59 billion, a 35% decline from February. Since corporates could not sell their mortgage-backed securities without being forced to realize the significant unrealized losses in accordance with GAAP, they were increasingly relying on borrowed funds to meet the share withdrawals. As the value of the mortgage-backed securities being used as collateral for the borrowings continued to decline, many corporates were finding it impossible to fund withdrawals made by consumer credit unions going forward. In order to ensure that adequate liquidity remained available to the credit union system, NCUA took unprecedented actions. NCUA's goal was to keep liquidity flowing so that payment system transactions, such as members' checks, could be funded, demand for consumer lending could be met, and the reliance on outside sources of liquidity could be reduced. In the next few slides, we will review the actions that NCUA undertook to maintain adequate liquidity for the credit union system. The key to maintaining adequate liquidity in the corporates during the economic crisis was to maintain the confidence of the consumer credit unions. Consumer credit unions needed to know that their funds in all corporates were safe. An outflow of consumer credit union share deposits without adequate liquidity to fund them would result in some corporates being forced to sell mortgage-backed securities at significant losses. Later in this installment, we will discuss how a forced sale of the securities would be more costly to consumer credit unions than allowing those corporates to continue holding the securities. But for now, let's focus on the need to maintain consumer credit unions' confidence in the safety of their share deposits at corporates. To avoid the possibility that the corporates would not be able to meet consumer credit union liquidity needs, on January 28, 2009, the NCUA Board adopted the Temporary Corporate Credit Union Share Guarantee Program. The Share Guarantee Program provides an NCUA guarantee of all shares in the corporate, excluding paid-in capital, or PIC, and membership capital, MIC, accounts. The Share Guarantee had the desired result. The outflows of funds from corporates stopped. Consumer credit union confidence in the safety of their funds was restored. Some of the funds that had been withdrawn from the corporates returned. A month after the announcement of the Share Guarantee, consumer credit union share deposits at the corporates grew to $80 billion. Throughout 2009, consumer credit union shares in the corporates fluctuated between $70 billion and $80 billion. As a result, corporates were not forced to sell their mortgage-backed securities and recognize the unrealized losses. Another program that NCUA used to address liquidity was the Temporary Corporate Credit Union Liquidity Guarantee Program. This program was created by the NCUA Board on October 16, 2008. The Liquidity Guarantee provided an NCUA guarantee for new unsecured debt obligations issued by corporates. For a nominal fee, corporates were allowed to issue debt obligations guaranteed by the NCUA for liquidity purposes. Issuance of debt is a normal business activity. However, the economic crisis caused a major disruption in the global credit markets, blocking access to liquidity. The NCUA Liquidity Guarantee made debt issuances by corporates possible during the economic crisis. The Liquidity Guarantee benefited corporates as it provided them additional avenues to generate liquidity. Consumer credit unions benefited since their corporates were able to gain access to funds so they could meet their members' liquidity needs. As the liquidity crisis unfolded, NCUA also used direct resources and the authority it has to provide liquidity. The Central Liquidity Facility, known as the CLF, is a government corporation created to improve the financial stability of credit unions by meeting their liquidity needs. The CLF was created by Congress, and it is overseen by the NCUA Board. The CLF has the authority to make loans to consumer credit unions, but is not permitted to loan to corporates. To make loans, the CLF borrows from the Treasury Department's Federal Financing Bank. As the liquidity crisis grew, the immediate concern was ensuring adequate liquidity for the needs of consumer credit unions. The corporates had historically met that need. It was essential that a backup liquidity source be put in place. CLF had not had significant amount of activity in recent years. The CLF's full statutory borrowing limit was approximately $41 billion, but a borrowing cap of $1.5 billion was in place. Due to three factors, the projected liquidity needs of consumer credit unions, the inability of the corporates to meet those liquidity needs without selling mortgage-backed securities at a loss, and the amount of private label mortgage-backed securities held by the corporates, $1.5 billion was not an adequate amount to meet liquidity needs. In September 2008, NCUA obtained congressional authorization for the CLF's full statutory borrowing limit of $41 billion. As noted earlier, the CLF could not directly provide funds to the corporates. NCUA developed several programs to use the CLF as a means of easing the demand for liquidity in the overall credit union system and injecting funds into the corporates. We will discuss each of these programs in turn. The Credit Union System Investment Program, known as the CUSIP, was created by the NCUA board in November of 2008. While the liquidity guarantee was able to assist corporate credit unions in obtaining funds in the financial markets, there was also a desire to more actively utilize CLF funds to ease the liquidity burden. As we noted, CLF cannot lend directly to corporates. Thus, CUSIP was developed through NCUA's coordination with the Treasury Department and the Federal Reserve Board of Governors as a means for consumer credit unions to borrow funds from CLF and then invest the proceeds in guaranteed notes issued by the corporates. The infusion of funds by consumer credit unions through the CUSIP enabled corporates to retire secured external borrowing subject to collateral calls, thus easing the liquidity burden at the corporate level. The consumer credit unions benefited as guaranteed notes paid a spread of 25 basis points. The corporates benefited as the invested CUSIP funds were used to retire external borrowings. Since its inception, CUSIP raised a total of $8.2 billion. The Credit Union Homeowners Affordability Relief Program, known as CU-HARP, was created by the NCUA board in November of 2008. The mechanics of CU-HARP are similar to those discussed for CUSIP. Under CU-HARP, consumer credit unions borrow from the CLF and invest the proceeds in guaranteed notes at a corporate. The consumer credit union benefited as the guaranteed note paid a bonus coupon up to 100 basis points if the credit union provided documented interest rate relief for distressed borrowers. As such, the consumer credit union was able to assist their members who were at risk of losing their homes. The corporate benefited as the invested CU-HARP funds helped to ease the liquidity burden. CU-HARP raised a total of $164 million. In the previous installment of this series, we provided information on other than temporary impairments, or OTTI, charges on securities. OTTI charges are required to be reflected through current earnings. In the absence of adequate earnings, OTTI charges are then absorbed by capital. In late 2008, as the economic crisis continued to intensify, the analysis of the investment portfolio of U.S. Central reflected increasing OTTI charges. In January 2009, the estimated OTTI was $1.2 billion. This amount was approximately equal to the U.S. Central's total capital. Once U.S. Central recognized the OTTI charges, the corporate would have been, in effect, insolvent. Once a financial institution nears insolvency, business partners, investors, and customers question the institution's viability, that is, its ability to continue to operate effectively. In the first installment of the series, we discussed that the credit union system is a three-tiered system. The retail corporates obtain services from U.S. Central. One of the key services that U.S. Central provides to the retail corporates is assistance in critical aspects of payment systems processing. We also noted earlier that it was critical to consumer credit unions, their members, and the overall American economy that payment system transactions and processing could continue uninterrupted. Therefore, it was essential that action be taken to ensure U.S. Central's ability to continue in its payment systems processing role for the credit union industry. On January 28, 2009, in an effort to maintain the stability of the entire credit union system, the NCUA board injected a $1 billion capital note into U.S. Central. Basically, $1 billion was deposited in U.S. Central to absorb losses in excess of U.S. Central's capital. This was done initially out of the Share Insurance Fund, or NCUSIF. With passage of the legislation creating the Temporary Corporate Credit Union Stabilization Fund, or Stabilization Fund, the NCUA board reassigned the capital note to the Stabilization Fund and the NCUSIF was repaid. As we will discuss in a moment, this was the least costly alternative for the credit union system. Additionally, the capital infusion allowed U.S. Central to continue to provide essential services to its member retail corporates, which in turn passed those services down to consumer credit unions and their 90 million members. In the previous slide, we discussed the action taken by the NCUA board in January 2009 to stabilize U.S. Central. However, conditions related to OTTI at both U.S. Central and Western Corporate Federal Credit Union, or WestCor, continued to deteriorate until early 2009. The expected losses were in excess of the capital for both corporates. Member confidence in the ability of U.S. Central and WestCor to remain viable and continue to provide services began to deteriorate. The losses threatened the ongoing viability of both corporates and the services their members were dependent upon. WestCor provides service to approximately 1,100 consumer credit unions that serve millions of consumers across the United States. The potential loss of WestCor's services would raise significant problems for each of those 1,100 consumer credit unions and their members. However, even more critical would be the possible disruption of services at U.S. Central. The 26 retail corporates obtain services from U.S. Central that they pass along to their members, which are consumer credit unions. One of the most important services U.S. Central provides is assistance with payment system processing. A disruption in the payment systems processing at U.S. Central would potentially affect nearly every consumer credit union and would have devastating repercussions for tens of millions of consumers. Essentially, such a disruption would have placed the credit union system in what is considered systemic risk. Therefore, on March 20, 2009, the NCUA board placed U.S. Central and WestCor into conservatorship. The conservatorship action was taken to ensure uninterrupted service to the 26 retail corporate credit union members of U.S. Central and the 1,100 consumer credit union members of WestCor, as well as conserve and protect the assets of the institutions. Under conservatorship, NCUA operates the two corporates. The board of directors of both U.S. Central and WestCor were replaced by NCUA representatives. The CEOs and some key personnel with responsibilities over the areas that caused the existing problems had their employment terminated. NCUA continues to oversee the operations at both corporates as we work to bring about a permanent and least costly solution to the problems related to the mortgage-backed securities. All of the background that we have provided up to this point in the presentation is leading up to the question on everyone's mind: why is my credit union being forced to pay for the losses at the corporates? In describing the situation, it is helpful to look at the impact of the problems as a cascading series of effects throughout the credit union system. In the next few slides, we will examine the scenario that NCUA faced in late 2008. As background, it is important to understand that, just like share deposits in consumer credit unions, share deposits in corporates are insured by the National Credit Union Share Insurance Fund up to $250,000. Corporates maintain a deposit with the insurance fund in an amount of 1% of insured shares, just like consumer credit unions. However, many consumer credit unions have traditionally maintained deposits in corporates that were significantly higher than the insured limit. In fact, most of the consumer credit unions' shares in corporates are uninsured. This is a key factor for understanding the impact of the corporate losses on consumer credit unions. Losses at a corporate that affect insured shares are covered by the Share Insurance Fund, just as in consumer credit unions. Thus, this is a cost all insured credit unions would pay. In addition, as we just noted, most shares in corporates are not insured. However, the uninsured shares belong to federally insured consumer credit unions. Thus, uninsured shares are not protected, and they would have to absorb losses in the event of failure. These losses to federally insured consumer credit unions on uninsured shares would create failures of consumer credit unions. This would cause more losses to the Share Insurance Fund to pay for the insured shares of members of the consumer credit unions that failed. As a result, all federally insured consumer credit unions, not just those with deposits in corporates, are susceptible to losses at corporates. We will highlight this point as we go through a detailed discussion on the potential losses and actual cost to the credit union system. In the fall of 2008, when it became apparent that there would be increasing losses on the mortgage-backed securities held by corporates, there were approximately $63 billion of mortgage-backed securities in the corporate system. Based on market estimates at the time, it was projected that there would be an approximate loss of $33 billion if all the securities were immediately sold. If NCUA had not taken the actions that we noted in the past few slides to ensure adequate liquidity and to stabilize the corporate system, there was the very likely possibility of a catastrophic loss scenario, namely the forced sale of the mortgage-backed securities. There was a total of only $2.4 billion in retained earnings in corporates to cover the $33 billion in losses that would be incurred with the sale of the securities. After absorbing all of the retained earnings, there would still be more than $30 billion in losses associated with the mortgage-backed securities that would have to be absorbed predominantly by consumer credit unions directly. As we discussed in earlier installments in the series, once retained earnings are absorbed to cover losses, the remaining losses are next applied to the paid-in capital, PIC, and membership capital, MIC, accounts held by consumer credit unions at the corporates. In late 2008, consumer credit unions held approximately $4 billion in PIC and MIC accounts. Once retained earnings were depleted, the PIC and MIC accounts would be absorbed next. The consumer credit unions holding PIC and MIC would be required to write off those accounts. This action would still leave some $26 billion in losses to be absorbed. This is only the first order of cascading losses. With the capital accounts at the corporates fully depleted, the corporates would be insolvent. There would still be $26 billion in losses to be absorbed. As we noted earlier, most consumer credit union shares and corporates are uninsured. If the corporates were liquidated as a result of the losses, only an approximate $1.2 billion of the total $64 billion of total consumer credit union shares would have been insured. To summarize the losses in the first cascading event, all retained earnings in capital accounts at the corporates would be eliminated. All of the $4 billion in PIC and MIC accounts at consumer credit unions would be eliminated. The share insurance fund would incur direct losses of $1.2 billion paying out on insured shares. Consumer credit unions would have nearly $63 billion in uninsured shares at insolvent corporates. It was projected that between 885 and 1,200 consumer credit unions would fail due to the first cascading event at a cost of $4.7 billion to $11.7 billion to the share insurance fund. The previous slide showed the initial impact on consumer credit unions in a scenario where the mortgage-backed securities at the corporates were sold in the distressed market. We noted the first-order cascading effect on the credit union system. The second-order loss occurs after the impact of the losses in the previous slide. We indicated that, due to the losses to consumer credit unions' investments in PIC and MIC, losses on insured shares and losses to the share insurance fund, between 885 and 1,200 consumer credit unions would have been expected to fail. The failure of these insured consumer credit unions would have also had a severe impact on the share insurance fund. It is estimated that the cost to resolve these failures would approach upwards of $10.5 billion. These losses to the share insurance fund, in addition to the losses to the fund noted on the prior slide, would pass on to federally insured credit unions with the impairment of the 1% deposit that all insured credit unions hold in the share insurance fund, as well as premiums to restore the fund. This, in turn, would create up to an additional 1,300 consumer credit union failures at a cost of additional billions of dollars. By the time NCUA resolved all the failed consumer credit unions, the impact on the credit union system would have been catastrophic. Total capital in the credit union system would have been reduced by $40 billion, and as many as 30% of federally insured credit unions would potentially have failed. In addition, consumer confidence in the credit unions would probably have been irrevocably damaged. This, in turn, could have created additional financial problems for those credit unions that were already now in a weakened state from paying their portion of the costs. The previous two slides showed the cascading impact on consumer credit unions in a scenario where the mortgage-backed securities at the corporates were sold in the distressed market. Failure of as many as 30% of all federally insured consumer credit unions and the significant reduction in capital in the survivors would have reduced the number of financially sound consumer credit unions. As such, there would be fewer viable merger candidates for severely weakened consumer credit unions. That would increase the cost to the share insurance fund to resolve problems and would lead to further costs. The impact of the losses and the failure of so many consumer credit unions would undoubtedly result in a severe reduction in member confidence. Member concerns with the safety and soundness of the credit union system could then very well lead to a run on shares, further compounding the problem of low levels of liquidity and leading to more consumer credit union failures. In such a scenario, which seemed to have a strong likelihood of occurring in late 2008, the cascading nature of the losses at corporates and the impact on consumer credit unions would probably have resulted in the demise of the credit union system. As such, it was essential that NCUA take action to prevent this danger from occurring. The key to reducing the cost was to find a means by which corporates could meet member liquidity and service needs without having to sell the mortgage-backed securities and to incur the market losses. The various programs adopted by the NCUA board, discussed earlier in this presentation, were the key to avoiding a catastrophic loss scenario and the resulting devastation of the credit union system. However, there were some costs associated with these measures. These costs were borne by the share insurance fund and, ultimately, all federally insured credit unions through premiums and assessments from the new temporary corporate credit union stabilization fund. But the cost was much less than it would have been had the securities been sold. In the next slide, we will discuss the costs that have been incurred as a result of the actions taken to stabilize the system. Additionally, we will look at actions taken by NCUA to mitigate the immediate impact of the losses on consumer credit unions. As we discussed in the previous slides, the losses at the corporates would have had an impact on the National Credit Union Share Insurance Fund and, ultimately, all federally insured credit unions. NCUA's goal has been, as much as possible, to limit the losses and their impact on the credit union system. In the previous slide, we provided details about the potential catastrophic losses if NCUA had not taken action. We noted that there were expenses related to the stabilization efforts, but that those costs were far less than what might have happened without those efforts. NCUA reviewed all options to find the least costly alternative to resolving the crisis. The costs related to the NCUA's efforts to stabilize the corporate system exceed the Share Insurance Fund's retained earnings and impaired 69% of the Share Insurance Fund deposit that insured credit unions hold as an asset on their books. In total, the cost to credit unions is 99 basis points of insured shares. In addition, many consumer credit unions were also required to write down the paid-in capital and membership capital accounts they held at corporates. When everything is taken together, there exists adequate capital in the credit union system to absorb the corporate's losses in holding rather than selling the securities. However, the combination of these expenses, if they were taken all at once, could have very significant consequences. First, there would probably be a contraction of lending and other services that consumer credit unions provide to their members. Second, the impact of large sudden losses on the financial statements of consumer credit unions, along with the contraction of services, could destabilize consumer confidence. During the financial crisis, it is vital that credit unions continue to be a source of consumer confidence and continue to make credit available to support an economic recovery. And finally, some consumer credit unions, already with low levels of capital, could become insolvent if they were required to recognize the losses all at once. The NCUA sought legislation to mitigate the immediate impact of the losses on credit unions. Through the agency's efforts, in May 2009, President Obama signed a measure into law to create the Temporary Corporate Credit Union Stabilization Fund. The Stabilization Fund is separate from the Share Insurance Fund. It will be used to pay expenses associated with the problems in the corporate system. The Stabilization Fund may borrow from the Treasury up to $6 billion at any one time on a revolving basis. The Stabilization Fund must repay the Treasury with interest the full amounts that it borrows. However, the NCUA board has discretion about the timing of each payment, as well as about the amount of principal to be included with each repayment. NCUA will borrow from the Treasury to pay for corporate losses, and then it will pay back the Treasury over time with funds from assessments on federally insured credit unions. Under the new regulation, the Stabilization Fund must close down after 7 years unless the Secretary of the Treasury provides an extension of the fund's life. By creating the Stabilization Fund, NCUA has been able to manage the assessments to credit unions over time, rather than to require them to be paid all at once. Spreading payments over time will help to prevent many credit union failures. As noted in the previous slide, the primary benefit of the Stabilization Fund is that it enables the assessments to credit unions to be made over time, rather than all at once. Again, the costs associated with the stabilization efforts are far less than a scenario where the securities are sold. However, the costs will pose challenges for many consumer credit unions. By using the Stabilization Fund, the financial impact on consumer credit unions will be less immediate. Consumer credit unions will have much more time to adjust their operations to weather the financial storm. Far fewer consumer credit unions will face insolvency through this approach. As such, more consumer credit unions will survive and continue to provide services to their members. The smaller impact on individual consumer credit unions' balance sheets should ease the concerns of individual credit union members. Maintaining member confidence in the stability and viability of the credit union system is critical to avoiding a potential run on shares at consumer credit unions. A run on shares could intensify the liquidity concerns discussed in the previous installment in this series. As we noted earlier, it is vital to the health of the American economy that consumer credit unions continue to provide loans to their members. By minimizing the immediate financial impact of the system's losses, NCUA's actions will allow more funds to remain available to meet members' credit needs. Finally, managing the assessment over several years provides time for consumer credit unions to review the final revisions to NCUA's new corporate rule. Looking to the future, the decision by consumer credit unions to use the services of the corporates and provide funds to recapitalize the corporate system will depend on their understanding of the business model based on the new regulatory changes. We will now wrap up our discussion of the corporate system by taking a look at some of the changes being considered in the corporate rule. It is impossible to write regulations that can address every potential problem and risk. The financial markets are continually evolving and new risks are continually arising. Moreover, if regulations for financial institutions were drafted with the goal of preventing all risk, financial institutions would not be able to operate. Risk, after all, is part of capitalism, and risk-taking accounts for our system's dynamism. However, there are lessons that were learned from the current economic crisis that can and must be addressed in shaping sensible regulatory changes for the future. It is imperative that the regulations governing corporates, as much as possible, prevent a similar crisis from occurring again. The actions taken by NCUA to date have focused on stabilizing the corporate credit unions and mitigating the costs. Before corporate and consumer credit unions can move forward, it is necessary to have any revisions to NCUA's corporate rule in place so that there will be a full understanding of the regulatory framework under which corporates will operate in the future. In January 2009, the NCUA board issued an advance notice of proposed rulemaking, seeking comments and recommendations for any necessary changes to the corporate credit union regulation. The corporate credit union regulation is in Part 704 of NCUA's Rules and Regulations, often referred to simply as Part 704. Those comments and recommendations were reviewed and, based on commenter input, a proposed rule was drafted and issued for public comment in December 2009. The comment period for the proposed rule ended on March 9, 2010. More than 800 comment letters were received. A number of town hall meetings and webinars with representatives of the credit union industry were held throughout the process of drafting the proposed corporate rule. The meetings and webinars provided the opportunity for an informed dialogue about the issues confronting corporates and the concerns of consumer credit union representatives. The comments and feedback will be used to make final changes to the proposed rule. The final rule will be issued later this year. Historically, corporates have had low levels of capital. As we discussed in the first installment in the series, corporates followed the credit union philosophy to return as much of their earnings as possible to their members. However, corporates also had lower levels of gross income than consumer credit unions. Most of their assets were in the form of short-term investments, which earned much less than loans which comprise the bulk of assets owned by consumer credit unions. Over the years, corporates have not contributed adequate earnings to build a strong level of capital. The proposed rule provides new capital standards to ensure that corporates maintain capital levels consistent with the risk associated with their assets and business activities. After a phase-in period, corporates will be required to have at least half of their 4% capital requirement be comprised of retained earnings. The proposed rule provides NCUA with new prompt corrective action tools for dealing with undercapitalized corporates. Prompt corrective action tools currently exist for consumer credit unions, but not for corporates. The proposed rule spells out specific actions that NCUA must take at corporates that do not meet and maintain an adequate level of capital. The low level of capital, in comparison to the increasing level of balance sheet risk, was one of the key problems that led to the current situation with the corporates. On the previous slide, we reviewed the actions proposed in the new corporate regulation to address the issue of low capital. On this slide, we will outline the proposed changes in the areas of corporate investment authorities and asset liability management, or ALM, requirements. In the previous installment in the series, we discussed credit ratings, how they are derived, and their use as a tool in making investment decisions. Credit ratings are a key tool in the financial markets, so the proposed rule does not prohibit their use. However, as we saw during the recent economic crisis, credit ratings are not infallible. As such, the proposed rule continues the requirement for the use of credit ratings in evaluating an investment. However, the reliance on credit ratings is reduced as a result of some of the other limits that are either introduced or strengthened in the proposed rule. The proposed revisions include requiring a corporate to review all the ratings from every credit rating agency that rates a particular investment, and to use the lowest of those ratings rather than selecting a single credit rating agency's assigned rating. The proposed rule also reduces the exposure that a corporate can have to one obligor from 50% of capital to 25% of capital. An obligor is defined as the primary party obligated to repay an investment. For example, an obligor would include the issuer of a security or the taker of a deposit. The proposed rule will cut in half the existing level of exposure that a corporate would have in the event of a problem with one specific obligor. The proposed rule also introduces new specific concentration limits by investment sector. Investment sectors break down investments into specific groups. For example, mortgage-backed securities, student loan asset-backed securities, credit card asset-backed securities, and corporate debt obligations are each a separate sector. By placing limits on specific sectors, the regulation will limit the losses that a corporate will be exposed to in case a problem develops in that sector. If sector limits had been in place during the recent financial crisis, corporates would still have experienced losses on mortgage-backed securities. However, the amount of those losses would have been smaller at U.S. Central and Westcor, since they would not have been allowed to hold such large concentrations of mortgage-backed securities. In addition, the proposed rule adds requirements that will limit the cash flow mismatches between their assets and their liabilities and also shorten the average maturity of their investments. The more closely aligned the characteristics of a corporate's assets and liabilities are, generally the more liquid the balance sheet is. The proposed changes to the investments and ALM are intended to work together to ensure that the corporate's investment portfolio is safe and liquid, while it still provides sufficient flexibility to operate profitably and increase the level of retained earnings. We have not previously discussed corporate credit union service organizations, or corporate CUSOs, during this presentation. Although corporate CUSOs were not a direct cause of the current problems with the corporates, they are addressed in the proposed rule. A corporate CUSO is an entity that is at least partly owned by a corporate, that primarily serves credit unions, and that restricts services to those related to normal credit union businesses. Some of the typical services offered by corporate CUSOs include investment advisory, brokerage, payment system processing, and business consulting services. While corporate CUSOs did not contribute to the current problems, NCUA wants to ensure there cannot be the potential for problems to arise in the future. There are a number of incentives for corporates to move the services that they currently provide directly to consumer credit unions to a corporate CUSO. If a separate legal entity performs a service, it reduces the liability of the corporate credit union should any problems arise. Additionally, moving some operations off the balance sheet of the corporate will reduce its asset size. If the corporate has fewer assets, that fact will be helpful in attaining the proposed higher capital ratios. The potential problem with moving services to a corporate CUSO is that NCUA currently has less authority over CUSOs than it has directly over a corporate. Lack of NCUA oversight may put consumer credit unions and the Share Insurance Fund at greater risk. To address this potential problem, the proposed changes to the corporate rule provides NCUA with greater regulatory oversight of corporate CUSOs. In addition, permissible services are more closely limited to those that directly relate to assisting the operations of consumer credit unions. Any new service that a corporate CUSO would like to provide must receive prior NCUA approval. Another significant proposed change to the corporate rule relates to governance. Corporates exist to serve consumer credit unions. Consumer credit unions are the members of the corporates. There needs to be a clear understanding on the part of the consumer credit unions as to the business goals and objectives of the corporates to which they belong. If consumer credit unions are going to be expected to recapitalize the corporate system, they must have an informed voice in their operations. The consumer credit unions must have transparency with regard to the operations of the corporates. The proposed changes to the corporate rule require the disclosure to consumer credit unions of the compensation for the senior executives of the corporate. Consumer credit unions should be aware of the salaries, benefits, and bonuses being earned by the senior executives of the corporates in which they are investing their capital and on which they are relying to perform essential services. The proposed rule also sets forth minimum qualifications for individuals to serve on the board of directors of a corporate. Directors must represent member entities, and the majority of the directors must represent consumer credit unions. To qualify to serve as a director of a corporate, an individual must hold either a chief executive officer, chief financial officer, or a chief operating officer position. It is imperative that directors have an understanding of the financial and operational issues that confront credit unions. And finally, to ensure a fresh perspective and new ideas, the proposed rule provides for term limitations on directors. Individuals may not serve for more than 6 consecutive years on the board of directors of a corporate. As we said at the beginning of this section on the proposed changes to the corporate regulation, it is impossible to write a regulation that will foresee and eliminate all potential risk. However, the current proposed rule revisions address the specific issues that led to the current problems with the corporates, address potential future problems related to corporate CUSOs, and provide additional transparency and limitations in relation to corporate governance. This presentation has focused on the problems that led to the current situation with the corporate system, and on the efforts to stabilize the situation at the least cost to all credit unions. Now that we have done so, we need to look forward. What does the future hold for corporates? That question will be answered by consumer credit unions, who will need to take a look at the corporate credit union business model under the new regulatory framework and determine whether it meets their own business needs. Some consumer credit unions may find that their needs are best met through their continued relationship with a corporate. Other consumer credit unions may find it best suits their needs to obtain these services elsewhere. Corporates are certainly going to need additional capital to be able to operate as viable financial institutions. Consumer credit unions will be able to vote on the future of the corporate system by either choosing to provide funds to recapitalize their corporate or not. Whatever the future of the corporates, NCUA will continue to take action when necessary to ensure the safety and soundness of the credit union system. On a related note, NCUA continues to explore solutions for dealing with the distressed securities, often called legacy assets, that are held by some corporates. NCUA plans on providing a permanent solution for the troubled corporates by isolating and funding the legacy assets to provide for an orderly migration to a new regulatory framework and a stable, safe, and sound future state for the corporate system. The framework for the transition period will ensure the system's safety and soundness while enabling credit unions to decide how and from whom they will receive the vital services that corporates currently provide. Once NCUA has arrived at a solution, we plan to provide a full explanation of our plan to the credit union community. This brings us to the end of the third installment in our series. Our goal in producing these presentations has been to provide you information so that you can gain a better and hopefully a more clear understanding of what led to the current problems confronting corporates and how they impact consumer credit unions. We took a look at why corporates were created and at the services they provide to consumer credit unions. We reviewed the events that led to the problems in the real estate market and the impact on corporates' ability to provide liquidity. We looked at the reasons why the value of mortgage-backed securities owned by several large corporates declined, and at the accounting requirements that forced the recognition of losses and the erosion of capital. Next, we reviewed the actions taken by NCUA to stabilize the corporate system and ensure that service to members has been able to continue without interruption. We also addressed the cost to consumer credit unions and the efforts to reach the least costly solution to the current problems. And finally, we reviewed the proposed revisions to the corporate regulations, which intend to prevent a similar crisis from occurring in the future. We hope that the presentations have been helpful to your understanding of the problems that affected the corporates and, in turn, all consumer credit unions. For the past 40 years, corporates served an important role in helping consumer credit unions provide services to their members, whose ranks now number nearly 90 million. In the future, consumer credit unions will need to decide whether a relationship with a corporate still offers value. Such a renewed relationship will come at a cost, the cost of recapitalizing some of the corporates. Or, consumer credit unions will need to decide whether it is in their own best interest and the interest of their members to forego the cost of recapitalization and to instead seek services elsewhere. This will be a defining moment for the credit union industry. Whichever decision consumer credit unions make with regard to the future viability of the corporates, NCUA is committed to ensuring a regulatory environment that establishes the safety and soundness of the credit union system.